Hey everyone, me Kevin here. I'm really surprised and shocked to see Mr. Farrelly over at JP Morgan finally start to flip-flop. This is a big deal for the entire economy, the stock market, the real estate market. Look, let's be really clear. There are a lot of bears on Wall Street, and that makes sense. It's because there's a lot of uncertainty. I don't blame any of the bears. I have a lot of friends who are legitimate bears who are very concerned that the Fed is driving rates up so tight that we are going into a recession. And there are others that say there's no way we're getting back to 2% inflation without a recession, that usually it's a recession that kicks us over the edge. Now, Farrelly over at JP Morgan is an analyst who's regularly been on the side of recession, relatively bearish. It seems like every time the market rallies, the bears get quoted in news articles and they're like, you should sell this rally. It reminds me a lot of Michael Burry in January of 2023. It's like, bro, how could you tweet sell? Now, I know, hindsight. But I mean, come on. Things were pretty dang low in December of 2022. So, what did Farrelly say this morning? How is he starting to flip-flop, and how does this relate to the boiling of the frog? Well, actually, it's easiest to start at the boiling of the frog. Another department, and then we'll get to Farrelly. And then that's a big one. Another department over at JP Morgan released this piece where they talk about basically data trending towards either a Goldilocks scenario where we have this magical soft landing and inflation goes away, or maybe we're just boiling the frog. Boiling the frog is basically a way of saying you kind of put the frog in the pot of water when it's, maybe 80 degrees, nice and warm, kind of like you're at the beach in Florida, 85 degrees maybe. Then you turn up the temperature to like Mexico beach water levels, and then you turn it up to like, oh my gosh, you're boiling, and you don't even realize you're in a recession until it's too late, and then the Fed has to cut, and they turn the money printer back on, and then you have panic and more pain and massive layoffs. The big problem that everybody's trying to avoid right now is layoffs. Massive layoffs. Now, don't get me wrong. We've heard plenty of stuff about layoffs, but the problem with layoffs is twofold. Number one, layoffs and jobs are a lagged indicator. So we don't really know how much pain we've had, and looking at news headlines certainly doesn't help, but we don't know how much pain we've actually set ourselves up for until maybe 6 to 12 months later. Oops, that doesn't do great use. But the second thing about layoffs is that once you start going into the negative jobs growth and the snowball of firing people starts, then you often create an unsustainable recession. And so this is why they're saying boil the frog, because, I'm focused on the back. I can't have faces on there, and the focus changes. Anyway, but they're so cute. Anyway, and I'm talking about me. I'm just kidding. Okay, so the problem is, think about this just from a practical point of view, okay? Let's say you're a small business owner, you run a print shop, and all of a sudden you've got, you do business cards. I know most people do them online. So let's say you're you're youprinting.com. I actually like them a lot. # not sponsored. So you're youprinting, and all of a sudden, 20 companies that are your main customers lay off half their staff, and they don't need business cards anymore. And you're like, oh crap. Well, now we have to lay off, and then you lay off, and then the paper mill lays off its employees, and the paper mill lays off its employees in the paper town, and then all of a sudden the local grocery store and the restaurant and everybody else has to lay off employees. That chain is really, really slow to hit, or for us to realize it's hit. And once it's hit, it's really, really slow to fix it. It's hard to fix that chain of unemployment, because think about it. Even if you end up getting, you drop rates or whatever, and you try to stimulate people to buy business cards again, it takes a while for those workers in that grocery town at the paper mill to actually get their jobs back. Because you got to see that demand go up. Then you stretch the existing employees you have more. You make them work harder and longer hours. And it actually takes sustained growth again for those businesses to say, okay, yeah, let's hire more people in that paper mill town. So, in other words, one of the worst things the Fed could do right now is basically say, Yes, we are going to ruin our jobs market. Because if you ruin the jobs market, even turning the money printer back on again might not solve things. So that's why bears have a real argument there, and they're not wrong. They're not wrong to have that fear. Anyway, so JP Morgan, not Farelli, talks about this potential boil the frog scenario. They're only giving us a 20% chance of a soft landing. And the reason for that is now all of a sudden they think the recession's going to come in 2024 to the first half of 2025. I wrote LOL next to this because I swear all they're doing is like every 6 months they kick the can down the road another 6 months. Like this summer, it was all the analysts like, well, the recession's going to come at the first half of 2024. Now we're basically almost at the first half of 2024, late November here. And what are they saying now? Well, the recession's going to come in the first half of 2025. Good Lord. Like, would you just get it right at this point? I just wanted to bring this up because it's the latest sort of bear narrative of, well, we're gonna get screwed here. And this applies to the John Farelli narrative, which is even more bearish, but has a really interesting, potentially bullish tilt to it all of a sudden. What was fascinating, though, about this JPM piece and why I brought it up regarding boil the frog is obviously the argument of like, hey, if you create this job loss, I'm summarizing that, right? If you create the job loss, it's hard to fix that and you could create really big issues. But one thing that you are seeing right now, because you're not seeing that job loss yet, is you're seeing sufficient relief from manufacturers. Look at this. Considerable excess capacity appears to have opened in Germany and Chinese industries to large producers that could sustain downward pressure on core goods prices and less pressure in the labor market to find new employment. This is what they say elsewhere. Less pressure to find new workers in other parts of industry actually reduces core services inflation as well. So in other words, more productive capacity at manufacturers as the economy slows down means lower core goods prices. This is the deflation that we're starting to see at Walmart, Vans, Levi's. Prices coming down. We're going from disinflation to deflation. It's great. You've already seen it at autos for a long time. Okay, now you go to, now if we have all this excess capacity, maybe we don't have to hire as much. And so what happens? You get less wage pressures. Less wage pressures eventually translate into, less what? Less core services inflation, which is great. Less core services inflation and less core goods means what? Less inflation pressure. Okay, fantastic. So we put both of these together. Are we going to get boiled by the Fed? Well, the boil the frog fear may actually be reduced by something known as the wealth effect. Okay, great. Wait, we've heard the wealth effect before. That's not that interesting. As real estate prices go up, people spend more. As stock prices go up, people spend more. Great. But stock prices aren't necessarily going up. There's a lot of pain in a lot of various different stocks, although the indices have been doing pretty dang well. So a lot of those growth stocks have been getting whacked. So what is different here? Well, JP Morgan's actually saying the following about the wealth effect. Economic theory suggests that consumers feel wealthier either in the immediate term because prices are going up, or, listen to this, by some perceived future wealth increase. In other words, in the boil the frog scenario, JP Morgan is saying one of the ways you could stick a soft landing is if people keep spending because they believe that the value of their stocks and real estate is going to go up again. And because they believe that, what ends up happening? They end up sustaining the economy until that becomes true. That's the flip side that they're suggesting here, that on one hand, you could be boiling the frog, or on the other hand, maybe that is Goldilocks. So kind of interesting how the wealth effect has played out here, that people really believe this pain we're going through right now will be, dare I say, transitory. Yes, a lot of pain solving the high inflation we've had, but once it's gone, it'll be gone again. And no, this isn't a return to the 1970s of continued waves of inflation, though that is another bear argument worth talking about in a different video. Instead, JP Morgan's Farelli makes a really interesting argument. JP Morgan's Farrelly, remember, he's the bear, okay? He talks here about the final miles of getting inflation down will require a softer labor market. Remember how I said a softer labor market is a big risk, because if you really start going negative, you really could crush the economy into a recession for quite a while. That is very bad. Now, they believe that there's still a chance of a recession here. This is Farrelly and his team believe that there's still a risk of a recession here in 2024, as they expect demand to falter. Well, so 2 scenarios here. Boil the frog, demand falters. Goldilocks, demand stays up because people expect their wealth to continue to go up in the future. I don't know how sustainable that is, but anyway, they suggest here that a recession next year is a real possibility. We don't see inflation getting all the way back down to 2%. Thus, while the Fed may have enough breathing room on inflation to ease up on the economy, we don't see the Fed returning the funds rate all the way back down to their estimate of neutral. Instead, and this I thought was incredible for a bear to say, because right now we've got, hey, recession coming, Fed's going to stay higher for longer, right? Ready to hear what he says? This was so exciting when I saw this. I wrote finally right here. The Fed will resort to the 90s strategy of opportunistic disinflation, an approach in which the Fed doesn't take further pricing action with increasing rates and actually just keeps policy, quote, modestly restrictive. That's very different. That's a very key word there, because you're used to sufficiently restrictive right now. Modestly would mean we're going to go lower but not as low to, quote unquote, finish the job. Okay, so how do we reconcile all of this? Because this has been a lot of information, and I think it's useful to try to put conclusions together. Let's do that on a piece of paper here. So the way to put this together is simple. So on one hand, you have Goldilocks. Okay, Goldilocks is one scenario, and then you have the boil the frog scenario on the other hand. So how do we piece it together? Well, what we have is we have Farrelly kind of leaning over on the boil the frog scenario from the other piece, which is a way to say that the labor market will soften, likely a lot. It's already in the process of softening, so I think going from a trend of 180,000 job gains, which we've actually been above that and we've kind of been starting to trend down, going to something like 100 to 150,000, not as bad. You start going negative 100,000, that's when you could potentially get an unsustained trend towards recession. So I'm going to suggest that this probably has to be around sub 50K growth of jobs per month, and that Goldilocks would be above 50K growth in jobs per month. So it's a nice little separation here. Goldilocks, in my opinion, counter to what Farrelly says, is actually op disinflation. Opportunistic disinflation, again, is a way of saying, hey, the Fed's okay taking its time. I'm shocked to see a bear say this, because if you go back to the 1990s, the 90s were a great time to invest, leading all the way up to about 99, right? Obviously before the dot-com bubble. And I'm not saying we're not setting up the next 2000. I'm just suggesting that we're probably more likely to be in the 90s, in my opinion, in the early 90s, like the 94 period of uncertainty, or 91, or maybe even 1982, right? These are scenarios where, yeah, we faced recessions. We were in the early 80s coming out of high inflation, but then we had 40 years basically of sustained growth in stocks, even through shocks and panics and recessions. Stocks basically almost felt like they went straight up during that period of time of the early 80s. And then throughout the decade of the 90s, same thing. So if we're in an early 80s, early 90s, that's fantastic, because we have probably 10 years, 8 to 10 years of growth ahead of us. Opportunistic disinflation, in my opinion, is a way of the Fed actually taking the foot off the pain pedal and saying, hey, you know what? We'll actually reduce rates a little bit, because we don't need inflation to be 2% tomorrow. We can afford to be patient. We could use flexible average inflation targeting, and we'll just wait for inflation to come down on its own over, whether it's through supply increases or the next big crash. but we're not going to engineer the next big crash right now. So that's why I put opportunistic disinflation over here with flexible average inflation targeting over in the Goldilocks scenario. I'm going to put 82, 91, 94, those years over in the Goldilocks scenario. I think we very much align with these timeframes. And I think the Farrelly argument is jobs crush, and that not only do jobs crush, but moderately restrictive will actually be painful enough to continue to drive us into a recession. And that would be the sort of boil the frog POV, where you're, we didn't even realize we just drove ourselves into recession. Oh no, the Fed's gonna be late again. So call this right here, Fed late, which is very realistic because the Fed was horribly late on realizing that they had created a massive inflation problem. So hopefully that doesn't happen again. Now, put all of this together. What does it practically mean for us? Well, I think practically you have to somewhat pick what percentage allocation you think is likely of each. If you're 50% Goldilocks, then maybe you're 50% in interest rate sensitive stocks that you think will do well going forward. If you're 50%, therefore boil the frog, we're going into jobless recession, it's going to be problematic, then maybe that's why you're 50% in money markets, right? If you're 100% bull, then maybe it makes sense to be 100% stocks, right? Depends on your personal portfolio, not financial advice. And vice versa. If you're 100%, no, we're boiling the frog, we're going into joblessness, maybe that's why you're 100% money markets, right? So, and that's okay. But I do think it's very interesting, bottom line out of all of this, that Farrelly, a bear, is starting to talk about opportunistic disinflation on the bearish side. That's not bearish. That's bullish, in my opinion. Let me know what you think in the comments down below. Thanks for being here. See you soon. Bye.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate an actively managed ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker.